Hello, everybody. Welcome to our webinar this evening. My name is Chris Entz. I'm a CFP and advice only planner and a member of the support team here at Advice. And thank you so much for joining us. This is your first time. These are webinars we do two every month. One is an office hour session for kind of more open questions, and the second one is these more case study focused sessions. So today we're talking about retirement spending. We're going to have lots of fun. I'll toss things over to Owen for a second, but just before we do, a little bit of housekeeping. We'd love your questions and we want to answer as many as we can. So if you have questions as we're going through the slides, as we're going through the case studies, please add them to the Q&A tab. I'll answer the ones I can via text or links, and I'll also funnel some over to Owen to answer live through our sessions. So please get those going. Again, we want these to be as useful as possible for you as you're building your plan on the platform. So thanks for joining us, and I'll kick things over to Owen.
Great. Thanks, Chris. So my name is Owen. I'm an advice-only financial planner, CFP, and the founder of Advice. And for those that are new to Advice, Advice is an easy and powerful retirement planning platform that you can use for just $9 a month or $49 for the year. In addition to the software platform and the AI strategies, we have our community forum for support, questions, discussion, and these webinars. So as Chris mentioned, this particular webinar will be about retirement spending. And if you've attended some of our past webinars, you know we'll do a little bit of a theory in the beginning. We'll go through a few different case studies together. We'll pull up the platform, go through some examples. We just want to show you how you can explore some of these things with your own retirement plan as you use the platform yourself. So we're going to be focused on retirement spending. Retirement spending is quite interesting. It's probably one of the biggest, if not the biggest lever in a retirement plan. It's, of course, very important. We want to get the most we can out of the retirement plan. We'll share some stats as we go through the webinar this evening. But one of the interesting stats is that for the most part, on average, retirees underspend their potential in retirement by as much as 25%. So there's a lot of potential there that's left on the table, and we want to ideally spend some of that if we can. So we want to tap into that unspent potential within the retirement plan. So that's going to be the topic is how much can I spend in retirement? We're going to be going through how to set retirement spending targets within Advice with different phases of retirement spending. So go, slow go, no go. We're also going to be doing some testing of retirement spending targets. So how do you evaluate your retirement spending to make sure you won't run out of money in the future? Is it successful? Then we're going to look at two case studies. The first one's going to be building guardrails for your retirement plan. So how do we set min and max retirement spending guardrails? Or how do we set safe and max spending guardrails? How do we give us a little bit of room to maneuver depending on how things change in the future? And then the other one will be just about adding additional spending on top of the plan. So additional gifts, could be additional spending, additional gifts, inheritance for children. Could be also testing things like long-term care costs. So how do we layer in those additional expenses in separate scenarios? So we'll go through that all. We're going to start a bit with the theory and a bit of the platform. So one of the key things to highlight, of course, is that Advice is driven by spending. So the platform is driven by spending. What that means is that we want to set an after-tax spending goal, a spending target in retirement, and the platform is working towards that goal. So we're using pension income, government benefits, investment withdrawals, and of course, we're planning for tax every year. The tax that we might have to pay might change over time depending the income sources that we have throughout retirement, but we're always aiming for that after-tax spending target. So the platform is very much spending driven. The other thing you might notice is that if we have more than enough income at certain phases of the plan, for instance, if there's RIF withdrawals or all of a sudden CPP or OAS kick in, if we've got more than we need for target retirement spending, the platform might end up putting that into a TFSA, perhaps for later in retirement. So that target retirement spending is an important thing to highlight because that's really what's driving all of the different decumulation within the platform. Now, the way we want to enter those expenses in Advice is one, we want to enter those in today's dollars. The platform will do the inflation adjustment for us. The reason why we like today's dollars for expenses is it's just a bit easier to comprehend. It's very hard to fathom the fact that you'll pay 2 to 3 more times for things in the future. But purchasing power, it's going to be the same as today. So what we like to do is enter it all in today's dollars. That way, certain expenses will just stay the same over time. Travel expenses, might change, but you can enter them in today's dollars, which is a bit easier to understand. And then the second piece is we use snapshots, so sort of broad phases of spending to capture things like go, go, slow, go, no go, or different other phases of retirement spending. So we sort of start with those broad phases, and then we can get more specific. So in the platform, there's two ways to enter spending. So one is when you're in discovery expenses, you can use simple planning to do a high level spending estimate and just kind of plug that in here. So in the top left corner of the discovery expenses section, you can just click the simple planning button. And then instead of entering itemized detailed expenses, you can just enter a total amount of spending that you're aiming for. You can do it per year, per month, per quarter. You can also split it between couples. But you could keep it simple and just say, I need 110,000 per year. That's my goal in retirement. So that's the easiest way to get started with retirement spending. Now, the reason why you might want to use that is one, lets you get started very quickly. You can just enter a ballpark figure. You can come back and add more detail later, which we would definitely encourage. But in terms of getting started quickly, you can just enter in that high level spending estimate and see kind of what that retirement plan looks like. Now, the other reason you might do this is you might have detail somewhere else. So maybe you have a detailed spending spreadsheet, you track your spending in detail, you do that offline. Maybe you're using another tool to do that. So if you've got that detail somewhere else, maybe you just want to plug in that high level estimate within Advice. So that's the reason why you might want to use simple planning, but you can also do detailed spending estimates as well. We would encourage that. The reason why we like to do a bottoms-up spending estimate is just to validate the retirement spending. You'll notice that we have different buckets here. We've got housing, transportation, personal savings, debt, and then within each of those, we have certain categories. Those categories are fixed, they're set. One of the reasons why we like that is it does make you think a little bit about whether or not you need to have something in that category. Home repair maintenance, great example. Maybe if we don't prompt you on that, you might not be thinking about the fact that, oh yeah, I need to maintain and update the home over time, new appliances, new furniture, etc. So that might be something that we prompt because we see that category might prompt us to enter some additional information. So detailed planning can be a good exercise to go through, maybe after you've done simple or if you don't have that detail in another platform. So why would you want to do this? Well, one, you want to map out your spending, especially for current year. One of the great things about mapping out your current spending is that it can really help understand retirement spending as well. Some things will stay the same. Property tax, great example, not going to be a big difference other than inflation year over year. Whereas another category like travel, hobbies, entertainment might see some big changes from one phase to the next. So mapping out your detailed spending in each category can just help us understand what changes over time. And of course, that's the snapshot. So having those snapshots lets us understand how things change, what the different categories look like in those different phases of retirement spending. It also helps us just envision what that might look like as well. So again, it's kind of prompting us a little bit to say, do I want to spend more in travel here, more in hobbies and entertainment? Do I maybe want to get rid of the vehicle in the last phase of retirement? All sorts of things that you can prompt on there. I'll pause for a sec before we look at cash flow. Any questions so far, Chris?
No, not so far. We're doing great.
Perfect. Okay. So the other reason we like detailed, if you're doing a detailed cash flow plan, is that you can then use the Sankey diagram here to visualize your cash flow. Again, we do really like this for current expenses because it does help us validate that we've captured all of the different pieces in your current spending. One of the reasons we like that is that for the most part, from working one-on-one with retirement planning clients, we do know that net income is usually fairly accurate. People know what hits their bank account on a monthly basis. That's usually a fairly accurately entered value. But when we look at the itemized expenses, sometimes we do notice a missing expense sort of category. So when we add the savings debt amounts, when we add in the individual spending categories, sometimes there's just a little bit that's unaccounted for. It could be 500 a month, 1,000 a month, but there is usually some amount there. So it gives us a good idea of what there is maybe a little bit there that we didn't itemize in our spending estimate, and maybe we should carry that forward into retirement. So really good exercise to go through. Maybe not initially, but we would encourage you to do that just to get a better sense of retirement spending. Now, the other reason why we like the phases for retirement spending is that we can see how things change over time. This is a great example. We've got monthly housing costs that are really different between early and late retirement, 910 a month. Same with transportation. It's relatively the same between different phases here, but we can see personal changes quite a bit, which makes sense. In that mid or early retirement phase, we're spending lots more on travel, entertainment, hobbies, certainly more than the current snapshot while they're still employed. And then in that final phase, we're spending a little bit less, but more than that working phase. So nice to see the different phases of spending and the itemized way lets us see what is changing throughout those different phases. So another good reason to do the detailed spending estimate as well. So standard phases, what we would typically see in a plan is a go-go phase, a slow-go phase, and a no-go phase. So your typical three-phase retirement spending. You can definitely add more phases. We've seen some people, add a fourth phase at the end with, sort of end of life costs. So all of that's possible. Three phases would be the sort of standard we'd recommend looking at first. And for go-go, we typically think about 75 as the endpoint, but 80 could be possible as well. Just then depends on health and how everything's going. So you might aim for age 75, have more spending upfront in those kind of prime, early golden retirement years. For slow go, we might say that's sort of 75 to 85. Again, a little bit less spending, a little bit less in terms of travel, maybe a little bit more local, maybe there's less activities and hobbies. Maybe there's a downsize, maybe there's less cost there as well. And that no-go phase, maybe 85 plus. So sort of end of life, we've got maybe less travel, no travel, maybe less in terms of hobbies and entertainment, but there could be additional costs there, care costs, medical costs, long-term care costs. So sometimes we can get a bit of a smile, retirement smile, where spending goes up towards the end of retirement as well. So three phases of retirement spending, typical within a plan. Oh yeah, go ahead, Chris.
Oh, we've got some good questions. So, first one, somebody's curious just to kind of calibrate their own spending results. If you have like an average or median spending estimate for Canadian couples during retirement or during the three phases of retirement.
Yeah, good question. So I think last time we looked, the median for a couple in Canada, and of course it very much depends on where you live, but across Canada, if you look at StatsCan, I think the last one was in the high 70s. And that was 2 years ago. I think they only released it after a year and a bit. So our estimate at 80,000 a year for a couple, after tax retirement spending, I would call that around median. However, it's very situational. So it depends where you live, depends if you're renting, depends if you own. But for a couple, 80,000 a year, individual typically a little bit higher. So 40 to 45 would be a bit more towards the median for an individual in retirement. But honestly, it can be low as 30, as high as 50 or 60, and that's still really in the realm of normal. So lots of variability there depending on, again, lifestyle, personal choices, travel, what that looks like. Everybody has a slightly different spending, obviously. Yeah,
Thanks,
good
Owen.
question.
Next question is about inflation. So inflation obviously has a big impact on spending. They believe that inflation is hard coded at 2.1%. They say 2%, but it's 2.1% on the platform right now. But they think that inflation is much higher with daily expenses. So can they revise that to at least 3%? How does that work?
Yeah, so I mean, in the platform, when you're entering expenses, the default is 2.1 for inflation. We do two things. We'll talk about stress testing the plan. So, stress testing not only includes investment returns, so stock and bond returns, but also inflation rates as well. So, we're using historical periods of inflation, including higher periods like the 1970s and 80s, where we had sort of double-digit inflation numbers. So, when we're doing the stress testing, we're doing it on both sides, not just investment returns, but also inflation rates as well. But you can definitely layer on additional spending. So we'll show you how you can add extra spending within the projection section if you feel like your particular spending, so maybe it's housing costs, maybe you're renting, maybe that's going up faster than inflation, maybe there's some risk there, you can certainly inflate those faster than the inflation target. So using an override, you can add additional spending there that increases over time. So definitely you can add more if you feel like there's a risk given your particular spending kind of makeup. Again, everybody experiences inflation differently, and the average, again, won't apply to everybody. So yeah, good question. You can definitely layer on more spending if you feel like that's a risk in your plan. Super.
Thanks, Owen. One more question. So, is it safe to assume that in a no-go phase with less spending, when you count for the risk of losing a spouse or losing CVP and OAS and long-term care costs, isn't it safer just to leave it flat and not to reduce no-go spending?
I think it's one way to approach it. I think what we would suggest is run that scenario on the side. So do a survivor scenario to understand what that risk looks like, to see if it's actually a risk in the plan or not. Reduce the spending for a survivor scenario to reflect that, some of those expenses won't be there anymore, but then there'll be a reduction in OAS, CPP, potentially a pension as well as, different tax, obviously, because now we can't income split. So what we would suggest is, don't just assume, don't just make that conservative assumption around retirement spending in the no-go phase. Test that in a separate scenario using the survivor scenario AI strategies. It's a great way to just evaluate if there's a material impact to your plan or not. That's one of the great things about the platform. You can have multiple different scenarios testing different, realities in the future. But yeah, good question.
Thanks, Owen.
Perfect. So, talking about adding expenses. So, one of the things that you can do in the platform, so if you're in planning projections, in the projection table, you can layer on additional expenses. So, the way we like to think about it is that you have your three phases of retirement spending, go, go, slow, go, no go. That creates the base. You can layer on additional expenses using overrides. So here we can open up the other category. We can use an override here to add additional expenses. Maybe this is a gift in this example, but you could also use this to inflate that spending as well, like we were talking about. So you can add more sort of risk of additional inflation in the future. Or this could be the long-term care costs. We'll show you that in a case study as well. So lots of room to add additional spending, layering that on top, even doing that scenario by scenario. And then let's talk about long-term care costs. So one of the concerns, of course, here is that there will be extra expenses later in retirement. Again, we would recommend running a scenario with that. We'll show you what that looks like in the second case study. One of the benefits for homeowners is they can tap into their home equity to cover some of these costs. Selling their homes an option. Tapping into the home equity using a reverse mortgage or HELOC is another option. But renters definitely want to stress test their plan to understand what those costs would do if they were to face them later in retirement. So we'll show you what that looks like in the second case study. And then we'll highlight that it's very dependent on location, maybe what subsidies you might be eligible for as well. So we'll do a bit of an extreme case. So we'll show you what that looks like and how you might stress test that in your own retirement plan. Speaking of stress testing, before we get to the case study, the platform does stress test your spending using the success rate analysis. So here we're using historical periods of stock returns, bond returns, and inflation rates. So again, inflation rates are included in this analysis. We're using that to test the retirement spending and see what percentage of historical periods would run out of money if we were to face them again in the future. So here, 9 out of 10 times we're going to be okay based on historical results, but 1 out of 10, 10% of the time, there might be a little bit of risk of running out of money. So again, we use this to stress test the retirement spending to make sure that we won't run out of in the future or to understand what that looks like. We'll see that in the first case study as we go through here. So let's jump over to the platform and we're going to show you some of the things we just talked about, and then we'll come back to the case study itself. So let me pull up the platform here. Any questions before we go through some of the platform inputs, Chris?
No, we're good right now. Let's jump in.
Okay, so we'll come back to this, but let's go to discovery first. I'm going to show you how some of these things are set up. So in the expenses section, obviously we could flip to simple, but here we've got already detailed. We've got three retirement spending phases set up: go, go, slow go, and no go. We've got the current spending at age 65. So that's their current spending right before retirement. Now, a few things to highlight here. So one, we can set those different phases. We can see their retirement spending estimate. Some of these remain the same, right? So we've got the same property tax throughout. We've got the same utilities, home repair, maintenance. Those fairly typically will remain the same over the course of retirement unless you move or switch homes or downsize and start renting. So a little bit easier for housing. For transportation, we've got the same here. So for the first couple phases of spending within the plan, we've got generally the same expenses. So not too much will change, although maybe if they had a long commute, they might reduce the vehicle maintenance, reduce the fuel gas costs. But here, maybe they're working from home and they've got relatively similar costs into early retirement. But when we get down to personal, we can see some big changes. So this is one of the benefits of doing that detailed expenses estimate for each phase is that we go from vacation travel, we're spending $500 a month, 6,000 a year, up to the early retirement phase, the go-go phase, we're at 2,000 a month, 24,000 per year. So big jump up in spending in travel. We can see a couple shifts here in restaurant and entertainment. And then in this sort of slow go phase, we see it drop back down to 6,000 a year. But very clearly, we know what we're spending more on in that early go-go retirement phase. And we also know how much flexibility we have because we can see here most of the other things are kind of the same. Clothing, personal care, not going to be a big change from now in early retirement, but vacation travel, we're adding $18,000 on top of what they're doing at the moment. So really good visibility, especially when we get into stress testing the plan. If we have some room, we know that there is, or if we have the need for some room, we know that there is some here in that travel budget. Now, the other one I want to highlight here is that if I go one more to the right, and we've got the no-go phase, in this particular plan, we've gotten rid of their vehicle costs. So this is age 86 to 95, so that last phase of retirement spending. But we've just shifted that into sort of public transit, Uber, taxi, rental vehicles. So maybe we don't have a vehicle. Maybe we can choose to continue to have a vehicle, but we did allocate that cost to a different category. Total amount's about the same. We've just put it in a different category. Again, it's just being more deliberate about those spending decisions as we get into retirement. Anything else to highlight on this one, Chris?
Somebody's curious about if you could go through how to add more phases to the expenses. So how do you add more snapshots? Because they were limiting themselves to just three, and you don't have
Okay.
to limit yourself to just three.
Yes, we would encourage you not to add 10 or so, but you can definitely add more than three. In this case, we've got four or five, usually fairly typical. But yeah, really good question. So let's go through an example here. So we can, in any of these snapshots, we can click this little menu icon. We can add a financial snapshot. So that adds a blank one. We can set the ages and all of the values will be zero. But what we really like to do is once we've got the current spending kind of dialed in, making a copy of that financial snapshot is typically easier to do. So again, a lot of those categories kind of remain the same. We might as well use the current spending as a baseline. So copying your current spending and then even maybe deleting, sort of the defaults that the platform added can be a very quick way to do this spending exercise. So yeah, just click that little menu icon, click the copy financial snapshot. You'll be prompted to add a name for that snapshot as well as an age range, but you can always come here and then remove or delete the other snapshots or edit the timeline as well. You can do that as well, but you'd probably end up removing the default ones that the platform added. So start with your current expenses. I would recommend filling those out in detail. Make sure that the cash flow diagram looks relatively complete, and then come back and start copying those into other phases, tweaking the categories that you expect to change or want to have change in retirement. Hopefully that answered the question, but yeah, good prompt.
It did. Thanks, Owen.
Perfect. Okay, so let me show you cash flow as well. So one of the reasons why we like the detailed cash flow is that it does give us a good sense of how accurate we're being with the current expenses. And let me give you an example. There's no missing expenses in this one, but let's imagine that they hadn't been quite as accurate when they're entering their information. What you might see in your plan is something like this. So this missing expenses, the platform is identifying that between net income and all of the itemized expenses, there's about $600 missing. Again, usually net income we've entered fairly well, it's fairly accurate. All of the itemized expenses might add up to a certain amount. In this case, it's $600 short of what that net income number is. Now, I want to highlight this. The platform does, to be safe and to be conservative, it does add that to your current expenses in the projection and your retirement expenses. So that missing expenses, if you don't know exactly where it's going, we would recommend adding it to your miscellaneous, Or if you do find your bank account, your checking savings account does increase over time, maybe you are saving it just indirectly. So depending on where that money is going, either add it to savings or add it to your miscellaneous expenses. In this case, they know fairly certainly that they're saving $1,000 a month, so this must be spending. And so we don't know where it is, but we're going to add it to miscellaneous. And we've already done it before, but we're going to carry that forward into retirement as well. So we've got the same $800 all the way through. Not 100% certain where that is, but we do know that there's a bit there that we're not sure where it's going. But this now gives us a very detailed cash flow estimate, and the platform won't carry that forward for you automatically. You can be a little bit more deliberate about telling the platform where that spending is going. Perfect. Any questions on that cash flow at all, Chris?
Not yet, but if you do have some questions on the cash flow, if you're struggling there a little bit, just let us know.
Great. Okay, so let's take a look at projections, see how this rolls together. So let's start with the spending chart here. So this visually, we can now see those three spending phases. So we've got that pre-retirement. We're spending more in retirement in the go-go phase. Again, we had more travel, right? We were adding travel, switching around some of the expenses. We do see that drop here a little bit when we get to the slow go phase and then no go phase down a little bit more again. So here visually, we can see those three phases of retirement spending. Um, and then I do want to highlight two other things. So one, plan funded. So plan funded is a ratio that looks at how well the plan is able to meet your lifetime spending number. So in this case, we're aiming just shy of $3 million in spending over the rest of the plan. Plan funded is looking at how well the income in the plan, so either CPP, OAS, and pensions, plus the assets, the available financial asset, how well they're able to meet that spending goal. In this case, we've got a bit of a surplus. We can see here at the end, there is a bit of buffer within this plan. However, on the other side, we've got success rates. So success rates under 100%, which means that if we look at historical periods, even though the straight line sort of projection looks okay, we've got a surplus. If we look at historical periods, there are 18% of historical periods that run out of money in the future. So this success rate looks at historical periods of stock returns, bond returns, and inflation rates. We can see at the 10th percentile, around age 90, we're running out of money in the future. But in total, by age 95, we've got 18% of those periods that are running out. That being said, we do have 82% of periods that end up with money left over at the end, sometimes a lot of money, sometimes two, three, four, five, $600,000. So this plan funded versus success rate measures the straight line sort of ability of the plan to meet your retirement spending. And the success rate does the stress testing with inflation rates and investment returns just to see historically how many of those periods would still be successful. But let me know if there's any questions on that. That's usually um, a bit of a deeper topic.
I'm sure that they will come in, but we have actually a few questions. It's not specifically on spending, but it is around income and kind of meets into this a little bit. So somebody's curious about if they have retirement income that isn't indexed to inflation, how would they freeze that kind of income level throughout the tool?
Oh yeah, great question. So you're right. In by default, when you enter it into the income section, it does assume it goes up by inflation. However, in projections here, if we open up the income, we can add an override. So let's say other taxable income, we had 5,000 a month, 5,000 a year would instead of clicking the button to increase by inflation, we would cascade that down to the end of the plan. I'll put 110, but it'll just push it to the end of the plan in this case, and it will be a flat amount. So yes, if you do have certain expenses or income sources that don't go up by inflation, then you can enter that or override that here. Now, if it's a pension, that's already in the pension number. So if you have a DB pension, that will already be included when you do the data entry in the discovery phase. So you'll be able to indicate whether or not it goes up with inflation already. But yeah, good question. If you do have an additional income source that doesn't have an inflation adjustment, you'll have to override the default, which is that inflation adjustment. Perfect. Any other questions?
Yes. Sorry, Owen. So we're just answering some questions in the chat as we go through, so I'm a little bit behind here. So if they've just moved into retirement, how do they enter gross or net income?
Oh, if you don't have any income, just leave it zero. Yeah,
Yeah.
so there is a help resource that explains if you've newly entered into retirement or you're in early retirement, how to enter your income values. But yeah, if you have no income sources other than your investment income, then that income section will be blank for the moment. If you have a pension, you'll enter your pension in the tax and benefits. If you have CPP and OAS, you'll enter that. But if none of those things have started and it's just the investment income, the platform will again help you with that decumulation. So using the AI strategies, using the target spending, it will explore, what's the best way from your investment assets, what's the best way to create that retirement spending. So yeah, don't need to enter anything in discovery if it's just investment income that you have. Perfect. Yeah, good question.
Perfect. Okay, so we've got a bunch of questions asking about some success rate things. Some of them are asking for the right success rate values, and we're going to talk about that just in this next section. But
Sure.
a few questions about the success rate. So somebody's wondering, can the success rate be adjusted? So obviously there's a super fast increase for a few years, and then it go down just as quickly. That kind of relates a little bit to the guardrail conversation we're going to be having as well, right?
Yeah, so what's the question? So if spending goes up really quickly for a couple
No, I think
years?
it's this idea that success rate can it be adjusted as you go? Because obviously, a couple of years into the plan, it can go up, but then you can
Oh,
have downs, and these pathways really can change dynamically.
yeah, I mean, so what this is showing is essentially all the different paths that your retirement plan could take, and we have no idea which path we're on, unfortunately. And that is the idea with updating the plan every year is that, every year we get new information. So we get a little bit further along the path. We sort of validate which path we're on a little bit more, and then you'll update the plan. So hopefully, knock on wood, hopefully we continue on the path that we've been on. We have some good investment returns. And hopefully you end up a little bit higher than the 50 percentile. And then you would redo the plan, re-update the plan, and see what sort of new opportunities that creates. Sometimes it creates new requirements in the plan, new drawdown requirements. If your RSP has grown a little bit bigger, you might need to do some additional tax planning, or maybe you're a non-registered account or TFSA. So there are a number of different things you'll want to look at. Now, the next webinar will be on how to update the plan in the new year, so definitely come to that one. But yeah, that's one of the benefits of updating the plan year over year is you can really see which path you're on and whether or not you need to make any adjustments. Hopefully you're on the upper path and it's a positive adjustment. If you're on a lower path, at least you know now already that you need to make some changes before it's perhaps too late. But yeah,
Great.
good
And
question.
one more success rate question before we move on. They're curious about how often you adjust the historical rates that we're using for that calculation in the success rate chart.
Yeah, so historical rates get updated every year with another year of returns. But of course, historical is historical, so it doesn't really change. So this doesn't shift too much year over year. The only thing that changes in the platform from a rate of return perspective is we do shift the expected rate of returns, the inflation rates, based on FP Canada standards. So all the CFPs in Canada should be using the FP Canada standard rate of returns for long-term planning. And we do if it's off by a tenth of a percent. So if it's plus minus a tenth of a percent, we don't make a change because it's relatively close. But if there is a big shift in expectations for whatever reason, we will update that in the platform. Usually that comes out in March, April. So typically you'll see all the tax and benefit rates get updated Jan 2nd or 3rd. And then you'll see perhaps in March and April a shift in the expected rate of return. So yeah, hopefully that answers the question.
Great. Thanks, Owen.
Okay, so let's flip back over. Let's talk about this case study. And hopefully we can get through both of them. So the thing that we want to highlight here when we talk about guardrails is are we spending enough? So, like we talked about, there has been recent studies that have shown that on average, retirees spend less than they could. So, up to about 25% less. They're spending 75% of what they could be spending using their available assets and income sources. And of course, actually, that underspending increases with age. So, if we want to get the most out of the retirement plan, we want to figure out how to tap into that 25% that otherwise maybe we're a bit more reluctant to spend. The problem here is that we want the permission to spend more, but we also need to balance these other risks within the plan. So having one spending target isn't really enough. We need to be a little bit adaptable. So we want to create a range of spending options so that as things change within the plan, we know the range that we need to work within. So we need that safe level, that min level, we need that max level. And that's the idea behind the guardrails approach is that we're giving ourselves, again, through testing the plan, every plan's a little bit different, but we're giving ourselves a little bit of a range to work within depending on what actually ends up happening over the next few years in retirement. So we might have our target retirement spending that might have a certain success rate. 84% might not feel quite high enough in terms of success rate. You might want to know, well, what's my safe level of spending? That doesn't feel quite safe enough. So we might do another scenario with a lower guardrail, and we're going to do this together. But in this case, we might spend just a little bit less. In this case, it's going from 107 to 101,000 in early retirement. So only a $6,000 reduction, but now we have a 100% success rate. The benefit here with the lower guardrail is that we don't need a bigger reduction than that. We're identifying what is the biggest reduction that we need to have a very high success rate based on historical returns. We don't have to spend $12,000 less in this case or 18,000 less per year. We only need $6,000 less. So again, if we've got the discretionary spending, that might be quite comfortable for that retiree. Now, the problem with that is that that leaves a lot of money towards the end. So we also want an upper spending guardrail that gives us a better idea as if things are on track, if we're getting median or above average investment returns, how much could we spend in the plan? So we want to have those two guardrails for retirement spending. Now let's flip over to the platform. We're going to do that together in that case study we were just looking at. So let's go back here to target retirement spending. And in this case, so this was our target spending. So sort of similar to the example. So we had retirement spending 112, 113,000 a year. Age 76 goes down to 95 or so, and then we're down to 77, 82% success rate. So it's okay for a medium, but it's maybe not super comfortable. Maybe these clients, they want to understand, what is the safe level of retirement spending, the minimum level that would give us a higher success rate. Let's go over to the safe spending scenario. I'll show you how we set this up. So here we've got a 99% success rate, and this is super easy to do. So you can make a copy of your scenario, your base scenario, and then here we're just going to filter on modify retirement spending, and already the platform is exploring these options for you. So very quickly we can see that if we just reduce spending by 6,000 a year throughout retirement, we're going from an 82 to a 99% success rate. So very quickly we can see what we need to do to increase the success rate for that lower guardrail. It doesn't have to be a $12,000 reduction. It doesn't have to be an 18. That gets us too high, too conservative. 99% of the time, just a $6,000 reduction is okay in this case. And remember, they were spending 24,000 a year on travel in early retirement. So we know that $6,000 is entirely reasonable. They can still spend 18,000 a year on travel and be perfectly fine throughout retirement. And if we look at the success rate here, now we've got all of these lines, they kind of maybe skirt close to the bottom, but they're not quite at zero, except for that 1% of cases. Um, there's still a drop in early retirement, so it still might be feeling a little bit uncomfortable, but as long as we're not worse than this, then we know that we'll still be successful in the long run. Remember, their spending drops here at 76 anyway, so they only have to get through that early retirement phase. We don't want to go too low with that retirement spending. And so this gives us a really good lower spending guardrail. So that success rate looks quite good. The problem with this is that if this was their target, very successful plan, but 99% of the time we end up with a lot of money left over in the end. So could be a couple 100,000, could be a million. Uppercase here is 2.8 million. So that might be too much. And that is a bit of the problem with being too safe, too conservative in retirement. So the other scenario we want to run, and we should always have two or three, but definitely is a max spend scenario. So here we're pushing the limit of the plan. We're down to a 53% success rate. We're drawing down all of the money by the end of the plan. We're even bouncing that last check here. We've got a bit of a shortfall. So this is that die by zero sort of approach. And we know what it takes. If we go down here to the AI strategies. We can filter by lifetime spending. We've already selected the one. It's increasing spending by 12,000 a year in retirement. So we already know if you want to sort of target that die by zero, that upper guardrail needs to be at a success rate around 50%. That's going to help you bounce the last check. So 53% is doing that for us. Um, so this is that sort of scenario where they could spend more. And now we've got a good guardrail. It's kind of -6 up to +12. So there's an $18,000 sort of room there that they need to play within. And if we look at success rate, definitely 50% of the time they're kind of getting right to the end there, bouncing that last check. If they face those poor investment returns, they would have to lower their spending. So we know that. We know what the safe spending guardrail is. So we know what they need to do if they face some of those poor periods. But as long as they're in that sort of median situation or better, they can keep spending that upper guardrail fairly confidently throughout retirement. So it gives us a good upper guardrail. Now, there's two ways to do this. So one, we added spending all the way throughout the entire retirement plan. If I remove this, let's recalculate here. And let's take a look here. We can also add additional spending in other ways. So if I rank by lifetime spending, so this is the one we did add. It's got that 53% success rate. But we could also have 53% success rate by adding 24,000 a year in early retirement. Maybe that's a better option. So maybe we front load the retirement spending, putting more in those early retirement years definitely draws down faster, but after that, it just sort of flat lines after 75. So depending on your goals, you might choose something like this, which really front loads retirement spending, in which case you want to be a little bit more sensitive about which path you're on in early retirement. But setting up those guardrails gives you a really good idea. Make sure you're not too conservative in early retirement with spending as well. Any questions there at all, Chris?
We're doing pretty well so far. We have a couple of questions that are a little bit off the spending target, so I'm just going to save them for the end a little bit.
Okay, perfect. Um, so since we got a bit of time, let's do the other case study. Let me flip back over here and let me pull up the slide. So we've got Abe and Susan, and this one's going to be slightly different. So Abe and Susan have a couple of questions. So they're retired. Abe's 65, Susan's 58. So there's an age gap there. So there's a couple of questions they have. One is, can we afford to give more to our kids now? And the second question is, because Abe's a little bit older, what if we need additional spending for long-term care? So how are we going to test that long-term care spending in a separate scenario for Susan if they don't want to sell the home in the future? So that's the big question here within this scenario. So we're going to layer on these expenses within their plan. So let me pull it up here, and then we're going to take a look at this together. So this is their base scenario. Quite successful. So they've got some mixed withdrawals here in early retirement. They're doing a bit of an RSP meltdown, plus some non-registered withdrawals. After non-registered is depleted, they go fully registered withdrawals all the way through. We've got some CPP phasing in, and then later for Susan, CPP and OAS as well. 98% success rate, so pretty darn successful plan. They're already spending 110,000 in early retirement, going down to 90 and then 70,000. They don't feel like they need to spend more. So the question is, with such a successful plan, they're ending up with a lot of money in their estate, in their TFSA. The question is, can they gift some of that money earlier? So let's take a look here. We've created a scenario with gifts. Now, what we would recommend, so first let me show you how we set this up. So we've got, if we go down to the spending, and we open up their personal spending here, we can see where we've layered on. We've got three gifts for 75,000 each, so 225,000 right in the early part of the plan. So we can see how that affects their plan here. Now, what we would recommend is when you add additional spending to your plan, you do want to revisit the AI strategies. So in this case, you could either make a new scenario which sets all of the AI strategies back to the default, but also clears all of the overrides. Or you can make a copy of the scenario, but then it keeps all your overrides, but you do want to revisit the AI strategies. In this case, we're doing a faster RSP meltdown Before, I think it was 40 to 50,000 registered withdrawals in early retirement. Now we're up to 106. We're still mixing withdrawals because we've got those big gifts, but we are drawing more in those early retirement years, just trying to smooth out tax a little bit more. So we would recommend revisiting the AI strategies. Even when you do the max spend scenario, you want to revisit the AI strategies because your decumulation order tax planning might change with that higher spending estimate. So in this case, we've already done that. We've got a different decumulation order here. We can see their spending is higher for 3 years. Then it drops back down to what it was before. And interestingly, their success rate is still 84%. So yeah, there's a bit more risk here. They might need to cut that spending a little bit if they do face some really poor investment returns or high inflation rates, but they've got a fairly good chance of giving those gifts and not having to make changes to their spending. So this is how you would explore the sort of additional gifts within the plan, just layering it on as an override in a separate scenario, making sure that that initial scenario is still successful. Anything to add on that one, Chris?
Nope, not specifically. I was answering some questions in the chat,
Right.
but I'm sure you did great.
Perfect. Thank you. Um, so let's look at the other scenario. So the one is the gift scenario, which was still good, but remember, Abe was worried about Susan if there was long-term care costs. So let's flip over to the scenario with long-term care costs. I will show you how we set this up. So one, we assume that Abe would go into long-term care at age 86 for 3 years. Now, on average, a long-term care stay is actually quite short. It's usually 18 months on average. Here, we've doubled it to 36 months. So we've got 3 years in long-term care. The cost in Ontario, 5,100. So we've added 60,000 in expenses for those 3 years. I'll show you how we added that down here. So if we go again to their spending, scroll down, we just added it under doctor, dentist, specialist. You could add it under other spending as well. We just added 3 years in today's dollars again, 3 years of that 60,000 per year. Now, the last thing we did is because after long-term care, we assume that Abe passes away, we could use the survivor scenario AI strategies, but in this case, we've set it for age 88. So 66, 67, 68, and Abe passes away at the end of age 88. So in this case, we also have what the survivor scenario looks like for Susan. If I close this, we did assume a spending reduction. If I scroll back to the left, we see that all of Abe's income stops at age 89. And if we open up Susan's income, we can see things like the survivor benefit rolling in. Unfortunately, it's not the full amount because Susan does get capped at the max CPP benefit. But we assumed a spending reduction here after Abe ends in long-term care. So $110,000 reduction in expenses. So that sets us up for the long-term care scenario. We've got the additional expenses and income here. We can see the spending, then that drops off to just Susan's spending. And the question was, are we still okay? Well, we can definitely see there's a drop in the net worth over time. On average, they'll be okay. But for success rate, it does drop. It's 64% versus that 84 we saw previously. There's definitely a little bit of risk there as we're paying for those long-term care costs for Abe. So in this case, we might need to look at some options. Now, luckily for Susan, there is a home to fall back on. So if we did need money later on in the plan, we could potentially sell the home, rent, move into long-term care there as well. So there's $500,000 we could tap into. But otherwise, we might need to look at a scenario with a slight spending reduction just to make sure that Susan would be okay in this case. So we can test the gifts in a separate scenario as well as the long-term care costs. In Susan's case with the home, we're a little bit less worried, but if you're renting, we would definitely want to run that scenario to see what the impact is and if we need to save a little bit more or keep a bit of buffer if that were to happen in the end of retirement. Perfect. Any questions we should cover, Chris, in the last couple minutes?
Yeah, so first question is, so somebody's just wondering, and I know it will depend here, but would it be a good strategy based on what we've been talking about today to shoot for a 50 to 60% success rate and maybe 110 to 120% funding and then adjust spending annually based on the previous year's returns? Is that kind of talk us through that?
Yeah, I think I would still encourage to have a bit of the guardrails approach just to make sure that you're not underspending in those early years. I think as long as we're not on a negative path, you can continue to spend that upper guardrail. So let's go to that max spending scenario. And here in this case, we would use this as a bit of a guide. So as long as we're hitting these net worth numbers year over year, it's just a good signal that we can keep spending that extra amount. And maybe we should change it back to the 12,000 additional instead of the 24,000 in early retirement. Um, so let's test this one here. Should be back to 53%. So this one was a little bit less extreme, more spending in mid go, go, slow go years. But in this case, we would want to just see every year if we're hitting this number, we can keep spending that higher amount. I think the approach of adjusting over time is okay. It's just that you're always behind. So you're always looking for the validation to spend more. Whereas I would say you can probably spend more and then adjust only if we see some really bad negative returns or high inflation rates. Slightly a different approach. Either way, we're adjusting the plan over time just to make sure which path we're on. In our example, we're sort of choosing the path ahead of time and just validating if we deviate from that path. In your example, we're sort of validating first which path we're on, and then we're choosing to spend a bit more as a result. I think we get to the same place, just a little bit behind, at least a year behind if we're doing it more after the fact. So still an okay approach, just maybe leaving a little bit more on the table.
Great. Thank you, Owen. Just a quick clarification about our case study here. What's the investment asset mix and return that we're assuming?
Oh, good question. Investment plan. So we've got 4.88%, 1% fees, 75, 25. So fairly conservative, I would say. But yeah, it depends on your asset allocation, drawdown, other income sources as well.
Great. Next question. So, in the world of investment returns are in nominal dollars, and they're wondering how does that translate to projections that are in real dollars?
Um, so yeah, so the projection is in nominal dollars. So if you go down to the table, you'll see these are the nominal dollar amounts every year. So for income, nominal dollars, future dollars. If we look at expenses, it's in today's dollars, but we do the inflation adjustment right beside here. So you can see 124,000 in 19 or 2035 will be 153 in future dollars. Purchasing power of 125, but of course, future dollars much higher. And then in the actual table or in the chart itself, although we show the charts in today's dollars, you can select future dollars. So you can see the value of the home going up in time. You can see your spending going up over time as well. It's just, again, today's dollars is a little bit more easier to comprehend. So think of it as purchasing power parity over time. Just a little bit easier to comprehend, especially when we're looking at, multi-year, multi-decade kind of projections. Um, Hopefully that answered the question, but otherwise clarify and we can come back to it.
Great. Thanks, Owen. Next question. If the expense snapshots have both simple and detailed amounts filled in, which one is used for the projections?
Ah, good question. So, yes, if we go up to the expenses section, so in simple mode, the platform actually is just hiding the detailed categories. So if you've started in detailed and said, nah, you're nuts to this, I'm going to go back to simple, you do need to clear out these values because they do actually still flow into the projection. They're not being deleted. They're actually just being hidden from view. So we would encourage you to go through and remove all of those detailed spending estimates and then when you flip to simple mode, you can just enter that single value there. But yeah, it's a good question. If you did start with detailed, clear out some of those values before you switch over to simple planning.
Great. Thank you, Owen. Can you talk a little bit about the success source of the success rate data? So they want to understand if they have an ETF like VGrow, how does that map on the success rate?
Yeah, so that maps quite well. So that's a very good question, is that the success rate analysis really is assuming sort of very broad indexed based investing. So we're using US, global, Canadian equity returns, Canadian bond returns, and Canadian inflation rates. And so certainly if you are more concentrated with your portfolio, if you're an individual stock investor, if you have a more concentrated portfolio, if you have one position that's quite large, then this variability analysis may not fully capture the variability that you'll end up experiencing. So it does assume a very high degree of diversification. Some sort of index-based investment, all-in-one ETF, individual ETFs, I think would be very well reflected by the success rate analysis. The more concentrated your portfolio, the more heavily weighted in a specific sector or a specific company, the less valid the success rate analysis will be. So, yes, from a variability perspective, we are assuming a very high degree of diversification here. It's a good question.
Great. Next question. So the platform works with after-tax spending. Is there a way to determine the gross amount each spouse needs to withdraw from each source to cover income tax expense?
Yeah, so the platform does take that into account. So when it's doing the drawdown, you'll see this is the gross amount that we're withdrawing from each of the accounts. So, for a TFSA, there's no tax, so it's just going to be 39,748 in this case. Um, but in early retirement, this is the pre-tax withdrawal, and then the platform is doing the tax estimate. If we can do the math quickly here, 151,753 minus the 26,792 in tax should be roughly the spending goal of 124,961. I'm sure somebody will do the math for me, but that's what it's doing is it's got all of your different income sources, post tax, doing the tax calculation, and then making sure that you will have that exact after tax spending amount. If you don't, you'll see a shortfall like this towards the end. Again, we're bouncing the last check here. We've got a $16,000 shortfall. So if for some reason the platform is short, if you've got a bunch of overrides or if you don't have enough financial assets, it will show you whether or not you're short on that spending goal. Great.
Great. Okay, so I think we've reached the end of our questions. For the ones that I sent out some links for, hopefully that's helpful. For the ones that we got to, hopefully you've had your questions answered. Thank you so much for joining us. These are always a lot of fun, flittering around doing all the questions and talking retirement planning, which we both really, really like to do. So if you have more questions, the best place to reach us is in our Reddit community. We're on there all the time, answering questions as much as possible. Also, there's a bunch of users that have been on the platform for a long time, offering um, great feedback and great comments as they go through. So it's a great place to hang out, ask questions. We'll do one more webinar this year. We don't have a case study webinar in December, but we are doing an office hours session. Part of that office hours session is going to be focused on how to update the platform. So in the new year, what's going to roll over? What do you need to think about? All those things. This is something that might be really helpful for you for the end of the year. There might be a few things you want to put in place. So catch that session or catch the recording afterwards. We do record these sessions. We send out the recording and post it on our YouTube channel on Friday. So you'll get that email with the recording and you can check out the YouTube channel for the recording as well. So thanks again for joining us and have a great rest of your week.
Thanks, everybody. Have a good night.